Hi and welcome to the week ahead video with me, David Madden. Before we discuss the major events of next week, let's just take a quick moment to recap on some of the big events that happened in the week just gone. Yes, this here is the US30, and it came under large pressure yesterday along with other global stock markets as there was a major switch in market sentiment. Essentially, the sell-off was triggered by fears that the Chinese economy was slowing down. Later Wednesday night, we heard an official from Beijing stated they would look to cut the reserve requirement ratio as a way of stimulating the economy. And even though this is typically a dovish strategy, it actually had a very negative impact on the markets. Stocks, oils and metals all fell. Traders took this as a sign that the very impressive rebound the Chinese economy has undergone in the past year or 14 months was slowing down. So we saw a fairly sizable decline in the US30 yesterday. It fell to a level last seen in late June rather. But since then we have seen quite an impressive rebound. In fact, most of the losses that were incurred on Thursday have actually now been recouped. Keep in mind the broader picture on the US30 is still very much to the upside. If you move higher from here and we have a break above 34,704, we could look to retest the 34,859 mark. Keep in mind this level here was actually a 2-month high. We have seen the similar situation with the US500. The S&P 500, whereby it endured a fairly sizable sell-off yesterday, but since then we have had a fairly impressive rebound. Notice how a large portion of the ground that was lost in Thursday's session has not been recouped today. If you can continue to hold above the recent lows, it's likely the broader upward trend in the US 500 will continue. A move on higher from here could see a target the recent record high, and a move beyond that could see a target 4,380. Now, in the past number of hours, we've had confirmation that the Chinese authorities have in fact cut the reserve requirement ratio. This should provide stimulus to the US economy. One of the key topics of themes of the last week or two has been demand. We are seeing some evidence that demand is ever so slightly starting to fade off in countries whose economies have reopened, such as the US. In the week ahead, we will actually see the US inflation figures on Tuesday, and we'll have the US retail sales figures numbers on Friday. Both of these updates should provide a good idea of demand in the US. Essentially, the retail sales will be most likely to be in focus. Because if Americans are going out and actually spending money, that's likely to keep the momentum seen in the US economy, and that's what's going to drive the recovery forward. Inflation in the US is high. It's currently at 5%, a 13-year high, but at the same time, US central bankers have said on multiple occasions they believe any rise in inflation is likely to only be transitory, so it's not something they're going to be acting on in relation to monetary policy anytime soon. And also in relation to demand, we have seen a fairly decent amount of volatility in the oil market in the past 24 hours too. This here is UKOIL. As we can see, it enjoyed a very impressive rally into early July, where it hit its highest level since late 2018. So it wasn't a very impressive run. Oil endured a fairly sizable sell-off in the last couple of sessions, partially because of the abandonment of the OPEC Plus meeting, partially because of the concerns in relation to China's economy slowing down. But in a similar fashion, we have seen a fairly impressive rebound in UKOIL. If we continue to hold above the recent lows and we continue to move on higher from here, we could be looking at testing 75.62, and a break above that could see a target 77.49. The oil market is also going to be important this week because we have a Bank of Canada will have their interest rate decision. Now, the Bank of Canada are highly unlikely to actually change monetary policy, but given there is often a strong correlation between the Canadian dollar and the oil market, we could see heightened volatility. This week we saw the US dollar against the Canadian dollar hit its highest level in several months. Dollar CAD hit its highest level since April. This was partially driven by the fact that the US dollar broadly had a fairly positive run, but it was also helped by the fact that the Canadian dollar actually sold off aggressively as oil moved to the downside. In the past 24 hours, as you can see here, we've seen a pullback in dollar CAD. That's because the US dollar has retreated, but also the rebound in the oil market has also helped the Canadian dollar. In addition to that, in the last half an hour, 40 minutes, we've had a well-received jobs report from Canada, whereby the number for the reading for June came in much higher than expected, adding weight to the argument the Canadian economy is improving at a faster rate than expected, hence why we've seen a bit of a drift lower in dollar CAD. It's possible we could see a further ground to be lost on dollar CAD in the near term, but as long as it holds above this region here, in around the 1 spot 23.20 region, it's likely the broader upward trend in dollar CAD will continue.